I'll end it here. Why did gold go up in January of 24 until January of 26? Why did gold go up $2,600? Excuse me, 3,600. 3,600. It went from 2,000 to 5,600. Why did it go from 2,000 to 5,600? Why? I mean, it's really easy to understand if you're paying attention and you look at history. It's because of what I'm talking about. The US economy is literally the engine for the whole global economy. It's about 25% of GDP. It's the biggest market. And if you look at how big our Wall Street is, 60%, global stock market, 60% is in the United States, 60. So the US economy is like the big gorilla of the world. And our bonds and our dollar are the linchpin of that. So if what I'm talking about, how you don't have, that the US is basically in this kind of this doom loop, this problem area, the rest of the world, if you're a foreigner and you're on the outside looking in, you're going, holy crap, the US is in trouble here. So that's the reason why gold went from 2,000 to 5,600. And that's why gold's back at 4,000, but it shouldn't be. It should be at 5,000. So gold, that was leg one. When we went from 2,000 to 5,600 in January, that was leg one. And silver didn't join the party until August of 25. It waited over a year and waited almost 18 months before silver joined the party. And then it went from $35 to $121 in January. And that was the end of leg one. But there's going to be leg two. And so that's what you need to realize is that leg two is coming. And I think leg two is going to begin sometime either in Q3 or Q4. And we'll end the year with gold around 5,500 and silver around 80 to 100.
According to Don Durrett, the U.S. economy has reached an endgame where the Fed must choose between fighting inflation or supporting growth, but not both. Durrett projects gold reaching $5,500 and silver $80 to $100 by year-end, with mining stocks still trading near all-time lows despite a frothy S&P 500.
Most people have no idea what's coming. So if you remember, everything that I said earlier in my opening comments about how the U.S. economy is basically manipulated based on money printing, our entire economy is based on the U.S. government borrowing money and expanding the national debt. Our entire economy is based on that. And if it can't borrow money, all hell's going to break loose. So if all hell breaks loose, that means the stock market's in dire straits, right? I think the S&P is definitely going down to 4,500, at least 4,500, and gold's going above 4,500. And so that's that 2 to 1, right? So what's going to probably happen is the S&P is probably going to go all the way down to 4,000 and gold's going to go to 8,000. There's your 2 multiple. Or it'll be 4,500 on the S&P and 9,000 on gold. There's your 2, right? And if you get there, if you go to 2, you can imagine how much money is basically flowing out of the S&P 500 and looking for a home. Gold only needs a portion of that. It doesn't need all of that. I mean, 5% will be plenty to make gold go nuts. It won't take a lot. Now, remember, this is just the U.S., right? Gold is a global market. People all over the world. As a matter of fact, the rest of the world buys more gold than the U.S. does. So the U.S. will just be joining the party. They'll be trying to give us some kind of attitude. And the East is going to go, no, we're not giving you any of our stinking gold. Just last month, China imported 173 tons. There's only 3,700 tons last year was mined. 170 times 12, right? That's how much, if they kept importing at this level. But if we just go to 200, it's 2,400 tons just for China alone. And so India imports as much as China. So those 2 countries alone could easily just soak up all the supply. So there's not enough gold to go around if you have a crisis. So this is what I always talk about: quality. You want to own quality. You don't want to own marginal. Remember I said earlier, one of the reasons where people make mistakes is they buy marginal stocks instead of quality stocks. So yeah, you definitely want to own quality, but you want to be smart when you buy, smart when you sell. It's getting starting to get difficult to be smart when you buy. We're still right now, we just had this correction. So we're down at this 200-day moving average where you can still buy smart. There's still, like right now, it's unbelievable. As we speak, the best gold miners are 4 and 5 baggers. So Agnico Eagle is a 4 bagger, which is kind of crazy at $7,000 gold, which I use. Barrick and Newmont both print as 5 baggers, which is amazing. So the best of the best are printed as 4 and 5 baggers. And you can imagine, so you can buy quality right now for cheap, which is amazing to me. I want to own as many quality producers as I can. I own most of them. And so but I'm smart about when I buy them. I don't buy them when they print as 3 baggers. And I like to print, the quality producers 5 to 8, and then the developers about 10 baggers or better. I don't buy a developer that doesn't have 10 bagger upside because they have more risk. So I'm usually in the 5 to 8 for producers and 10 for the developers. That's kind of how I do it. But I'm all about quality. Remember, I use my checklist. I'm always looking. And the other thing you do with quality is you allocate according to quality. The first thing that it tells you is that money is rotating out of stocks and into gold miners because gold's outperforming the S&P. So right now it's about 0.55. It was, I forget in 1980 how far it got to. I think it got to 6, which is absolutely crazy. That means gold was 6 times as much as the S&P, which we're not going to see that. And then in 2011, it was about 3.5, I think. So this time, I think it'll get to 2, which will be a beautiful thing if we get to 2. I'll be happy if it gets to, so when it really turns in our favor is when it gets to 1. But I think it's going to go to 2. So we're at 0.5. So that means gold's going to have to outperform the S&P by a factor of 100% just to get to 1. And then it'll double again to get to 2. And so if gold's outperforming the S&P by that much, all that you can imagine, the money's rotating into the miners. And so that's what we saw both in the 1970s and we saw it in the 2000s. And you have to ask yourself, how did that even happen? I came to the gold miners from basically the debt bubble. And so you really have to start why you're going into these things. Once you decide, okay, gold is going to be the winner here, and if gold's going to be the winner here, I want to use the miners as leverage. What is the thesis? The thesis is that the U.S. economy is basically gotten to a point now in kind of an endgame scenario where it can only do either fight inflation or support the economy, support economic growth. But it can't do both. It has to choose. We've never been in this situation before. But when I got into gold and silver, my thesis was that is the ultimate end where you're going to land. You're actually going to get to a point where you get kind of into a doom loop scenario where you're basically, because what we've been doing is we've been expanding the money supply, right? Our debt, our national debt's now 40 trillion, right? 40 trillion, and we're adding 2 trillion a year. So it's out of control, and everybody's starting to recognize it. So that's the thesis. You're like, okay, wait a minute here. Can you really print money to generate prosperity? Can you really do that? No, you can't. So what's happened is we've ended up with a K-shaped economy where a portion of the economy is working, right? The K-shape, the top 10%. It's working for them, right? But everybody else, not so good. And it's getting worse at the lower end, not better, worse. We've gotten to the point where we think that printing money is the be all, the end all. But now And this is the reason why I believe in gold. This is the reason why I believe gold's going to go higher. Gold's going to be the winner, because we've gotten to a situation now where you have inflation and you only have two choices now. That's why the Fed is completely trapped, which it was an inevitability. Once you let the free market go, which we did in '87, once you let the free market go, eventually you're going to get to this scenario where the market's basically going to eat you. There's a zero chance that they hike rates. And come on, man. I mean, who's working at Citadel? There's a zero chance. The only way that they would hike rates is if there was a plan to crash the economy. That would be the only reason you'd hike them. Because if you hike rates, you're literally hiking them into a seasonality issue where AI is basically the only thing keeping the economy above water, and you're going to basically poke that bear. No way. There's no way they're going to hike rates. Then they're going to do nothing. They're going to wait for the stock market to go below 7,000, and they're going to cut rates. The first thing you need to understand about an exploration is less than 1 out of 100 drill holes finds when it's basically a greenfield project. I mean, if you're trying to find gold, like 1 out of 100 holes finds basically an economic drill hole, something you can mine, if you will. I mean, it is really, really hard to find gold. It's really hard. Now, and now you're going to try to find an economic mine. It's even harder. It's like 999 out of 1,000. I mean, the odds are against you. That's why 95% of exploration companies are essentially worthless, because it's so darn hard to find a mine. The only way that an exploration company makes money is they find a mine. And it's hard to find a mine. Really, really difficult. I mean, you think about it, and that's gold miners. It's even harder to find silver mines. Right now, if you look at the number of basically, once they build the existing silver mines, the existing silver development mines, and there's only about 5 of them, once they build those, there's like no more. I often talk about, selling too early, selling smart. So a lot of people, I'll give it one example, is like a vino. A vino it went from 40 something cents, up to like $8. And a lot of people were basically taking profits, and there's this idea that it's never a bad idea to take profits. Well, that's true if you're an investor, but it's not true if you're a speculator, because when you're a speculator, you're trying to maximize your upside. So there's 3 ways to invest. The first way is the normal way, which vast majority do, at least 80%, and that is steady accumulation over a long period of time. So you want to make 5 to 20% every single year and just steadily accumulate, right? Just steady growth your portfolio, right? The second way to invest is to be a little more aggressive, but to also be short-term focused. In other words, you want to grow your portfolio annually, but you want to do it in chunks. You want to make you don't want just the 20%. You want more. You're trying to maximize. And that kind of works for gold and silver miners. The first way doesn't work. The first way, those are the people that come in to do gold and silver miners because they see it as it's got a lot of MOMO. They see opportunity and they get involved, but they have that mindset of steady accumulation. They're kind of breaking the rule. So if a stock is running out of juice, if you don't think it has. For me, if a stock doesn't have 5-bagger upside over the next 2 to 3 years, then it's starting to run out of juice. Then you might swap, but you got to be smart when you sell it. What are you going to swap it into? Are you really confident that, because a lot of times it's really difficult to know. What are you going to swap it into that's going to do as good as that stock? So it's going to get difficult to be smart to sell the top. Now, to finally answer your question, how do you know where is the top? When? And it's really easy. It's basically when the market gets frothy. Well, we know today that the S&P is frothy. How do we know it's frothy? Well, the Buffett indicator, right? All-time high. It's pretty obvious, right? The forward S&P, PE is about 22. That's frothy. We know the market's frothy, right? If you look at the miners, they're still bouncing on the bottom. They're like all-time lows. They're not even close to frothy. So we still have two more stages to go, and we have two more legs to go in miners.